Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. As usual, I have my esteemed co-host, Matt Nadeau here.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located locally right here in Barrington and serving the greater Chicagoland area. We are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies buying everything up these days.
And of course, as always, just want to stop, say hi to all of our clients. You tell us you listen every week. Hopefully you're having a beautiful weekend. We just want to say hi. And of course, we appreciate the trust that you place in us, and we love every one of you. Man, we have a great show planned, as always, but there's some really big topics I want to hit on. And again, we want to keep focused specifically on the Fed. We had a Federal Reserve meeting. But what's more important than maybe even the Fed is inflation and how that's going to impact the Fed. So we had inflation reports this week. We had some big Mag 7 earnings. We have semiconductor stocks falling. We had second quarter GDP. It's like everything, Ben. It's crazy.
Action-packed week.
So then we'll slow down. We're going to take the second half of the show, but we're going to talk about an important topic about your old 401ks. I know many people have a bunch of these 401ks floating around out there at old jobs, and there's some benefits of maybe combining those all into one IRA. And we're going to talk about the benefits for consolidating them.
And before we start, a couple things. First, we encourage you to subscribe to our YouTube channel on moneyhourradio.com. You can see this week's episode. You can see episodes as soon as they come out. We also have a fantastic weekly economic newsletter called the 5-Minute Market Brief. It lets you know a lot of what we're thinking and analyzing that week. You can sign up for that. It's completely free on bnwealth.com. And guess what? We are having our huge client appreciation gala in 2 weeks on Friday, August 14th. This is the once-a-year party where we run out a fancy country club. We have wine, dinner, dancing, live music by the nationally acclaimed Blue Water Kings. It's so much fun. And guess what? You have to be a client to come, but you have 2 weeks to become a client. That's plenty of time. So if you've been on the fence, if you've been wanting to speak with us, what a great motivation to hurry up and do that. All right, Matt, let's talk about this action-packed week.
Action-packed. Let's start with the Fed. All right, because we always circle the big Fed meeting. This week was Wednesday, and it really met market expectations. They didn't raise rates. They didn't cut rates. So the fact that they kept rates on hold, that actually spurred a mild and very temporary dovish rally, as a rate hike was maybe expected by a few people. There was some worries. However, the lack of any concrete signal on when rate hikes might occur actually caused the bond market, these longer dated Treasury yields, to go crazy and surge. And that's what weighed on stocks and caused a big sell-off right after the announcement on Wednesday. So additionally, we're talking about these long dated Treasuries. The 30-year yield rose to the highest level we've seen since 2007. And real yields rose even further, which that really increases a headwind on the economy. So this is happening because the bond market is getting concerned that the Fed might be falling behind on the inflation curve once again.
Matt, I'm seeing some scary charts lately. Comparisons about the last time Treasury yields hit that high. I'm seeing charts on money supply versus yields, all kinds of stuff. Here's the good news. Thursday, which is the day we're recording right now, it ended up being a huge recovery day. And here are some reasons why. Well, let's get into inflation. So the PCE inflation gauge falls for the first time since the pandemic. All right. But the danger is far from over. So the main inflation barometer used by the Fed to set U.S. interest rates fell in June for the first time since the pandemic. It actually underscored why the Fed took no action this week to raise borrowing costs. So the PCE index dipped 0.1% last month, and it's the first decline since 2020. And the yearly rate of inflation slowed to 3.7% from a 3-year high of 4.1% the prior month. Now, lower oil prices following a temporary truce with Iran were the chief source of the falling prices. So unfortunately, those going to go up a little bit.
Yeah, we'll see what the next month looks like. Well, another thing is that we had second quarter GDP, and it grew, a so-so 1.5%, but it was actually stronger than it looked. So the mediocre headline, of that 1.5% comes with a big caveat. A bigger U.S. trade deficit and smaller inventory replenishment actually shaved about 1.7% points off of the economy's growth rate. So the economy would have shown a much healthier growth rate of more than 3% if the trade deficit and inventories had just had their, maybe a neutral effect on GDP. So they tend to distort GDP in the short run, but they really don't have a huge impact on the economy. And then the U.S. economy sped up in the spring, even though we had the Iran war dragging on. And so it was a boost of kind of two engines: consumer spending and, of course, a lot of business investment out there, especially in AI.
Speaking of AI, oh my gosh, semiconductor stocks are just breaking down. It's been really bad. So semiconductor stocks have been crashing all month in July after a huge parabolic rise during April and June. And you could argue they were ripe for a big downturn. Certainly they've gone up so much. But man, it's getting ugly out there. So this week's acceleration downward was triggered by reports of a breakthrough by Chinese technology companies, which will increase competition in that space. So it's reported that 3 Chinese companies, Semiconductor Manufacturing International Corp., Hua Hong Semiconductor, and CXMT, they had made significant advancements in the production of advanced semiconductor chips, but at a much lower cost than those made in other countries. So that is a huge pressure on them. But guess what? Today, again, it's been a good day in the market on Thursday. They had a big rally as well. You could call it maybe a relief rally, but they're still up a lot, man. They're still up a boatload from where they were.
Competition, right? Maybe it helps everybody else in the end. Let's go.
Hey, something tells me the Chinese semiconductors are not going to be as good as ours, though. I'm just saying.
We'll see.
Okay.
I think you're right. But let's jump on to one other big thing that's been going on and we got to keep an eye on. Earnings. And they always clump, it seems like, the Magnificent Seven earnings into like 2 or 3 weeks. They all come at once. This week, we had another big week of earnings. And so far, as of when we're recording, it's been a mixed bag. And don't forget, Tesla and Google last week didn't have very good earnings either. So, we'll since it was a mixed bag, I'm going to start with the bad, Ben. I'm going to do the bad.
It's been like the Magnificent Two.
Yeah. So we're going to talk about Meta, Facebook, its stock's falling hard. And, this company right now is in Wall Street's doghouse. And here's why. They are just rampant spending on AI. And investors are looking for proof that they're going to actually make some serious money in something other than just advertising. So investors balked at the company's massive spending on artificial intelligence, coupled with what the uncertainty about what investments look like next year. So all that being said, after earnings, the stock, just even in a great day for the rest of the market, got trounced by over 10% or around 10% on Thursday.
It was already lagging going into that too. So, all right, next, Microsoft. Its stock is soaring towards a historic gain after earnings. And the company's cloud business is supporting impressive growth. And Microsoft expects to avoid heading into a cash burn mode as it spends up on AI. And Microsoft has finally started to convince Wall Street that it's striking the right balance on artificial intelligence, and that's translating into historic stock gains. And the company had been fending off criticism for its AI spending, especially as cloud growth had been held in check, but the latest earnings showed accelerating cloud performance. As a result, Microsoft was up like 17% today, the best result in 18 years.
This has been great. And let's talk about another one, Apple. It's been what we'd call the Magnificent Seven winner so far in 2026. So what once got Apple labeled as a laggard in the AI space has actually become a comparative advantage for the company. So investors have warmed to the company's relatively light approach to AI spending at a time when they're questioning the other companies having way too much spending and not getting the appropriate returns. So it was a joke. It's like, is Apple and Microsoft the only adult in the AI room right now for the Mag 7?
Seems like it.
And guess what? After close today of this recording, we got Apple on deck for their earnings. Amazon is also coming up. So we'll see what happens. That's why we didn't mention their announcements.
No doubt. But there's been so much volatility lately. Let me ask you something. Are you concerned about that? Do you want an investment strategy that protects your money in case the market gets much worse? Well, we think you should. And of course, we're talking about our Advance and Protect tactical investment strategies. To learn more, give us a call at 847. What is our number, Matt? 847-780-2980 or go to bnwealth.com. All right. Do not go away, because when we come back, we're going to talk about the benefits of combining old 401ks and old IRAs into one IRA. You don't want to miss it.
Welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we try and help you grow your money, pay less taxes, have a beautiful retirement. And I'm one of your hosts, Matt Nadeau. And of course, have with me my esteemed co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners. We're both wealth managers at Barzideh and Nadeau Wealth Management. It's a local, independent, comprehensive financial planning firm. We're located right here in Barrington, and we're here to serve the greater Chicagoland area.
No doubt. And before we start, we encourage you to like and subscribe to our YouTube channel called the moneyhourradio.com. You get to see this week's episode, all the previous ones. And then also, we encourage you to subscribe to our weekly economic newsletter. It's called the 5-Minute Market Brief. It's so good. We give our explanation of what's going on in the market, what we're seeing, what we're doing. It's completely free. You can sign up for that at bnwealth.com. And big news, we're having our Client Appreciation Gala in 2 weeks, Friday, August 14th. And it's our once-a-year party that is so much fun. We rent out a fancy country club. We serve wine, dinner. We have music, dancing, and it's live entertainment by the nationally acclaimed Blue Water Kings. So guess what? You have to be a client to come, but you have 2 weeks to become a client. That's plenty of time. And if you've been sitting on the fence thinking about when's a good time to come to us, hey, this should hopefully give you some motivation. So give us a call, schedule an appointment. All right, Matt, let's talk about our topic today.
Yeah. So our topic today is about combining your old 401ks or maybe all of those scattered IRAs that you have out there and consolidating them and combining them. So we're going to talk about a lot of the benefits. We're going to talk about a lot of stuff today. Remember, one size doesn't fit all. There's a lot of things you want to take into consideration. From our compliance department, they want me to make sure you know that. So, but we see that there are tons of benefits out there. And we're going to talk about, this is one of these most overlooked piles of money in America. They're old 401ks. You know, it's the retirement account from a job you left 5 years ago, the one you haven't looked at since you still had a company email address. And Karen from accounting kept reminding everyone to clean out the office refrigerator at least once. So
I have a friend named Karen. I have a feeling if she watches us, she's going to know we keep using her name. She's going to call me and say, hey, stop using my name.
Well, that's okay. You can deal with that. Listen, so here's the thing. Millions of Americans actually do change their job frequently throughout their careers. And we see so many times they're leaving behind these old 401k plans and retirement plans, and they're getting little to no attention. So if you have one of those old 401ks or maybe an IRA sitting around somewhere, it's the perfect time to just sit back and evaluate your options. And unfortunately, these forgotten accounts could really be limiting some of your investment opportunities, maybe limiting some of the options you have out there, and could be hurting your retirement savings from reaching its full potential. So the question just is, what should you do with those accounts and what are the advantages?
Well, here's one. So advantage number one is diversification. And one of the most powerful strategies available is rolling your retirement funds into a self-directed IRA. And it's kind of like upgrading From that nasty hotel buffet with 5 choices to an all-you-can-eat international food festival. That's because many 401ks give you a pretty short menu of investment options, usually confined to only a limited menu of mutual funds, target date funds. If you roll them over into a self-directed IRA, on the other hand, now you got choices and freedom to take control of your financial future. You can build a retirement portfolio tailored to your personal goals and investment strategy. And then depending on your custodian and your investment strategy, you may be able to invest in stocks, ETFs, real estate, private lending, precious metals, even private companies, and other alternative investments, of course, if it's suitable for you.
Yep, absolutely. And that's one of the big benefits. And another big advantage is ease and control. So instead of having to track several of these old 401ks from previous employers, you can now manage your retirement assets from a single account. This makes it easier to monitor your performance, rebalance your portfolio, and really make sure that your long-term investment strategy is meeting your goals. So instead of having to remember or log in to these 4 different or 5 different retirement accounts and wondering, wait, which one's this? Who's holding what? What's my login? Consolidating it makes your life a lot easier. You got one login, one strategy, a lot less digging through old paperwork that still has your previous address on it. But it's like Marie Kondo for your retirement.
She's so funny. She's that Japanese influencer, I think. She tells you best ways to organize it. She was on Netflix. You know, another benefit in this area, and it's slightly morbid, but eventually if we pass, when you have a bunch of different accounts laying everywhere, it's a nightmare for your beneficiary because to have to get paperwork on each account to transfer it over, you got to get death certificates on each account. Different institutions have different rules. So that's another feature that's really good about diversification.
And it might be really hard for you to make sure all your beneficiaries are correct if you have these old accounts floating around out there. Who knows who you put on an old job 20 years ago? You just got to make sure. Sometimes it helps consolidate to make sure those are accurate.
Such a good point. All right, advantage number 3, keeping tax deferral. So that advantage, and it comes with it, is the ability to continue enjoying the tax advantage of your retirement savings. A properly executed rollover allows money to remain in a tax-deferred account without creating a taxable event. By using a direct trustee-to-trustee transfer, your retirement funds move directly from your former employer's plan into your new IRA, helping you avoid unnecessary taxes, withholding, and potential penalties. And then choosing the right custodian is also an important part of the process. Not all self-directed IRA custodians offer the same investment options, price levels, service levels, or fee structures.
Yeah, and I'd even throw in there choosing the right advisor to help you with that, because we're rollover specialists. We do this all the time. But one of the big benefits of sometimes taking those old 401ks and IRAs and putting them into one account is then you can hire a professional that can help you with investment management and all of the additional financial planning needs that you need.
Absolutely.
Yeah. So I don't want to say this is all like perfect. There are pitfalls, and that's what I tried to say at the beginning. And there's a few things you want to think about before you start moving your retirement around, your money around like you're playing Monopoly. So let's think of a few things first. One, these self-directed IRAs, they come with some rules and things like prohibited transactions. 401ks, they're going to allow you to take money out at age 55 if you're still working there without the 10% early withdrawal penalty. If you are separated for service, if you're not working there. And IRAs generally do not. And this is where working with a knowledgeable financial advisor becomes incredibly valuable. A good advisor doesn't just help you fill out paperwork, they help you avoid these costly mistakes, go through and explain all your options, build a retirement strategy that'll then work to fit your goals. And it's including all of these, what we call orphaned accounts that are out there.
No doubt. So here's the takeaway. If you've got an old 401k collecting dust, like that treadmill that's become an expensive clothes rack, hey, don't ignore it. The account represents years of hard work with the right strategy, it could become an even more powerful retirement savings tool. In fact, if you count most people's 401k, whether it's one 401k or multiple 401ks out there, and you aggregate them, a lot of times that's by far the biggest investment account they have. It's bigger than their house sometimes. So you want to make sure it's working for you. And then a knowledgeable financial advisor, like you said, Matt, can help you evaluate your choices, explain the rollover process, hold your hand through it, identify solutions that align with your investment options and risk tolerance. And again, can help you from making those big mistakes. So besides all of the financial planning and things like that, and like you said, Matt, we are rollover specialists. So we do this all the time.
Yeah. And if you're out there and you're still working, maybe you don't have all these orphaned 401ks and accounts, but as Ben was saying, a lot of people, their biggest asset, usually even sometimes bigger than their house in cases, is their retirement account. It's their 401k. And so there are people who are like, I'd love to work with you guys. I'm really worried about volatility. I'm really worried about retiring, but I'm still working and I still have all this money in a 401k that has limited options. I can't use tactical investment management. I can't hire a professional. What can I do? And in fact, what we're seeing more and more now with these companies, and Ben, you know this, is that they're allowing something called in-service rollovers. So this is while you're still working for the company, where you're actually able to roll money out of your 401k or whatever other retirement account you have there and put it into a self-directed IRA, Roth IRA, depending on the tax implications. But it's where you can then move it into an account where you can hire a professional or manage it yourself if you were that professional. But we don't recommend that always for most people. But the benefit is then you can still be working for the company, still be making contributions, still getting the match, but take that huge lump sum of money and get it working for you with a professional.
And so many 401ks do allow that. There's two caveats. Your 401k has to allow it, which most do. You also have to be 59 and a half in most cases. So such a powerful way to get diversification and get the money out, have professionals like us manage it while you're still working there. And if you are in need of a good financial planner, someone who puts your interests first, we would be honored if you gave us an opportunity to speak with you. We'll go over your current financial situation, your goals. We can provide what's called a financial checkup, where we analyze your insurance, taxes, estate plan, investments, all at once. If things look good, you'll gain some peace of mind. And if there are holes, then you know at least what areas you may want to fix. Many people have told us they've never had someone look at all of the areas of their financial life all at once. If we can help you, that's great. If we can't, hey, that's okay too. We'll still part as friends. And also, again, big news. We have our big client appreciation event coming up Friday, August 14th. Fancy country club, wine, dinner, dancing, live music. You have to be a client to come, but you have plenty of time to reach out to us and becoming a client. So if you've been sitting on the fence, if you've been wanting to speak with us and you think, hey, what a great time for me to do that, give us a call at 847-780-2980 or go visit us online at bnwealth.com. All right, we are out of time. God bless you. We'll speak with you next week.